Hey Exampians, Exam Champions, welcome back to the channel. Today I am going to be covering some stuff about group health insurance that you're going to need to know to pass your life and health insurance exam. You have no idea how rewarding of a career there is waiting for you just on the other side of this exam, and I cannot wait to help you pass. If you'd like a free copy of my study guide, just click the link in the description of the video and I'll be happy to get it right over to you. Now, we're first going to talk about Cafeteria. Well, let's back up a little bit. So group health insurance plans are plans that are provided by typically employers. It's kind of like if you start working somewhere and you have to fill out your benefits package or request all the different types of insurance that you want. You check the box here, check the box there, decide what coverage you want. That's a group plan. So that whole options list is actually called a cafeteria plan. Now, it's kind of like when you go to a cafeteria and you can pick all the different options to eat, or say a buffet. It's more like a buffet where you can pick all the different options to eat. This allows an employee to customize their plan, select from a menu, and this flexibility allows them to tailor a plan to meet their individual needs. So some key features of cafeteria plans include benefit selection. So they can choose the benefits that they value most and opt out of ones that are less important to them. Employers can allocate a specific amount of money for each employee to use towards purchasing benefits. So they can say, hey, for each of these plans or for all the benefits combined, we're going to give you this much money towards purchasing those programs. And also they allow for pre-tax contribution. So if the cost of the benefits exceeds the employer's, how much the employer is putting in, then the employers can cover the remaining balance on a pre-tax basis. So for instance, say the company says, we will give you $500 a month towards these benefits, and it costs $600 a month, then the difference of $100 can be used on a pre-tax basis and come out of the employee's paycheck before the money gets taxed. So it helps them save money on taxes. So cafeteria plans are known as Section 125 plans. All these contributions would be treated as taxable. So for instance, if someone went and bought these same benefits outside of their employer, they would have to use it with after-tax dollars, which is more expensive, right? Because you get paid and then the taxes come out and then you get your paycheck. How it works with these plans is you get paid, the benefits cost comes out, and then that's what's taxed. The difference is taxed. So say the benefits, you get paid $1,000, the benefits $100. You only get taxed on the $900 that's remaining, and then you get your paycheck after that. So cafeteria plans are governed by Section 125 of the Internal Revenue Code, the IRS code, which is why they're sometimes referred to as Section 125 plans. Common benefits in a cafeteria plan are short-term disability insurance, long-term disability insurance, medical insurance, life insurance coverage, accidental death and dismemberment insurance, and also dependent care insurance. Some plans even allow employees to select different levels of coverage within that. So maybe within the medical insurance plan, there's different levels they can cover. Or in the disability insurance plan, there's different levels that they can cover. I really hope this is helping you guys get this stuff down, because I really want you to pass this exam on the first try. This industry has completely changed my life, and you're worth it, and I know you can do it. So there are a few underwriting considerations when it comes to group insurance plans. First off, the group cannot be formed to obtain insurance alone. So like a company that hires people, it was not formed, the employees didn't get together just to get insurance alone. Also, the stability of the group is taken into consideration. So they want to have companies that have a low turnover rate and don't have a bunch of people coming and going and quitting and being hired, because it leaves a more stable base for them to assess their risk from. They also want to check the persistency of the group. So the persistency is how long that employer remains with one insurance company for the health coverage or the different benefits that are available. Insurance companies don't like when an employer switches companies or switches insurance carriers all the time, because it just makes it look like they're trying to, bounce around. Benefits have to be chosen using a set schedule or system to make sure that there's no adverse selection. and that the benefits are evenly distributed amongst everybody. That way, like one person isn't going to get way more benefits than another and choose to receive way more benefits because they'll usually do that if they're more sick or sicker. I don't know the word. Also, source of premium payments is important for group insurance underwriting. So the source of premium payments is important because insurance companies like non-contributory plans. So a non-contributory plan is when the person who is obtaining the insurance does not pay for it, right? It's when the company pays for everything. It requires 100% participation, and insurance companies like that 100% participation because it helps them prevent adverse selection even more. They also look at the industry that the group is in. So is it a risky industry? Do they have a lot of claims that have been filed in the past? And they look at the size of the group. So a larger, more diverse group tends to be more stable, right? If it's a group of mainly older people or mainly sick people, they might take that into consideration when accepting the business's employees for a group plan. So when an employer obtains a group health insurance plan, they receive a certificate of coverage, okay? That's the agreement between the employer and the insurance company. The insurance or the policyholder, the master policyholder, who is the employer, receives the master policy, and then each person who participates in the coverage receives a certificate of insurance. So each employee would receive a certificate of insurance. Group health plans typically have larger or more extensive benefits, so they'll have lower out-of-pocket costs and higher maximum costs covered by the insurance carrier. There's usually a limited window of time in which the employee can enroll. This is called an enrollment period. So once they start work, they usually only have a certain amount of time that they can choose to elect to enroll in these benefits, after which they usually can't. They have to wait until the next enrollment period. And new employees typically have to go through some sort of a waiting period before the new coverage becomes available. I know when I started at a company a while back, it was like 2 months or something I had to wait before the new group coverage became available for me if I'm just starting fresh at a new place. Sometimes there are portability rules where, like, if you leave one place and then go to another, they'll let the coverage be continuous as long as there's no gaps in coverage, but we'll get into that in another section. So in order to be eligible for group health insurance, the group has to be formed for a purpose other than obtaining insurance. Some examples of groups are employers, trade associations, labor unions, creditor or debtor groups, lodges like fraternal orders, or multiple employer trusts, which are employers that are in the same industry. For unions, labor unions, there are things called Taft-Hartley trusts or negotiated trusteeships. So this is where it makes it so employers are not allowed to pay directly into a labor union for health costs. They have to pay into a trust, and then that trust finances the group health insurance for the union. So they just make them if it's funding coverage for a union, the money has to go into a separate trust, and then that trust funds the union's health coverage. The employer can't just pay directly into the union for the coverage. Now, typically the minimum number of people that's required for a group health insurance policy is 10, but this can vary from state to state. And temporary employees typically do not qualify for group coverage. They usually have to be full-time. Group health insurance plans typically provide predetermined benefits. These are established between the insurance company and the employer, and they're predetermined and based on a set schedule of benefits. And they also include different coverage limits. For example, disability insurance coverage amounts are based on how much the employee makes, because someone who if someone makes less money, they're not going to get as big of a disability benefit as someone who makes more money. So to be eligible as an individual, typically you have to be a full-time employee and you have to have a minimum of 1 to 3 months working for the employer to qualify. If someone is 65 or older, they must be offered the same health benefits as those provided to younger employees. Most states and companies require have a 30 to 31 day eligibility period when the new employee starts, meaning they have to enroll in group coverage within 30 days. If they want to get it after that, they have to go through underwriting and enroll in an individual plan. So they're only guaranteed acceptance for the group plan during that eligibility period when they first start working for the company. I've covered this a little bit, but there's two types of plans there's a contributory plan and a non-contributory plan. Contributory is when employees share in a portion of the premiums. So employees pay some of the monthly premium as well for the health insurance. That requires 75% participation from employees. And then non-contributory, where the employer covers 100%, that requires 100% participation. So when the employer covers everything for the employee, it's 100% participation and everybody has to be enrolled. There are a few factors that will determine the premiums for a group policy. Number one is the average age of the group. The higher the average age of the group, the more expensive that the premium will be. Another one is the waiting period for disability benefits. So the longer the waiting period for disability benefits to kick in, the cheaper the premium. The shorter the waiting period, the more expensive the premium. Also, the longer the disability benefits will last, the bigger the premium. And the shorter the disability benefits will last, the lower the premium. The occupation is taken into consideration too. So premiums might be higher for occupations that are more hazardous or exposed to more factors that could reduce someone's health or cause them to be sick or become injured. So insurance companies can offer coverage to small employers from anywhere from 2 to 50 employees as well. If a company has less than 20 employees, then Medicare is going to be the primary payer for the employee's claims. And if there are 20 or more employees, Medicare can be the secondary payer for the claims. So I hope this gets you a little bit more versed in group health insurance for your life and health or health insurance exam. I hope this helps you pass on the first try. Don't forget to click in the link in the description of the video for a copy of my free study guide. You also don't want to miss the next video coming up that's going to help you learn more about what you need to know to pass your insurance exam.